Expect the economy, this is in today's Wall Street Journal, expect the economy to experience elevated inflation this year, possibly even higher than in 2021.
It's not inflation on the mind of our headliner today. It's a word that a lot of people don't like to use when you talk about all this. Ed Yardeni is the president of Yardeni Research, and it's the S word.
Stagflation. Stagflation.
Stagflation.
Stagflation.
Stagflation.
The stagflation word. You really worried about that today?
I think we're in it.
It's a type of regime, the markets have not faced in a generation. So it's really something, that we have to pay attention to.
But what's really interesting, it's no longer good news for the stock market. That is what has changed over the last few weeks. Our biggest worry, which hasn't yet materialized, and I don't want it to materialize, no one invested in this market would want it to materialize, is stagflation. That you get lower growth and higher inflation at the same time. That is our biggest worry out there, and we don't want that worry to start being a big concern, let alone materialize, because then we have nowhere to hide.
If your face looked a little like this when you lately checked your portfolio, you're most likely not amused by the performance of your stocks, right? Just to put it into nice words. Actually, lots of investors have been putting on this face just lately. And you know what? It's probably getting even worse. What's the alternative though? Selling it all? Putting your money into the bank with ridiculously low interest rates? Or even getting charged for simply parking your money? Putting it into bonds? And if that's not enough, everything else around you is getting massively expensive, caused by the high inflation rate. So making you really think twice if you should get that sugar-free, venti salted caramel mocha frappuccino with soy milk at your very next Starbucks visit. Bah. So, if you want to know how stagflation is actually impacting your hard-earned money and what you can do to protect your portfolio, you click the right video. Get comfy, sit back and relax. You don't want to miss this. So let's travel back in time to get some perspective in the world we're living in right now. In the 70s, the US experienced an oil crisis, which impacted everyone's lives in quite a drastic way. The economy was slowing down. People were losing their jobs. Supply chain shortages led to skyrocketing prices. The inflation rate reached double digits. And remember, a healthy inflation rate is around 2%. On top of that, there was a devastating war between Israel, supported by the US, and a coalition of the Arabic states. So the Arabic states actually reduced their oil production by only 5%, which caused, however, a price increase up to 300%, demonstrating the strong dependency on oil. This, of course, heavily impacted the stock market, which ultimately crashed. So the MSCI World, for instance, crashed up to 50%, and it took in an entire decade. Yes, you heard right, it took 10 long years to recover from that shock. Oil, war, inflation, does this ring a bell to you? Are we going to experience the same? And if so, what can we do to prevent losing all our money? The solution is so simple. You just have to smash that like button and subscribe. I would really appreciate that and would help the algorithm and motivate me to pushing out more valuable content out to you guys. I wish it would be that simple. Guys, I'm Björn and welcome to this The Avenue to Revenue. Building wealth through simplified and long-term investments. There's one word which fears most central banks. Yes, it's the S word. Stagflation. Stagnation, inflation, stagflation. Stagflation is a toxic mix of a slowing economy, high inflation and a high unemployment rate. For now, the unemployment rate in the US looks rather healthy based on the data provided. In a recession, businesses fold, manufacturing output and demand, and thus prices fall. In a stagflationary environment though, it also comes with increased prices and high levels of inflation, making it an especially difficult problem to solve. Central banks of course have tools to combat stagflation or any kind of inflation, but they usually have to go into the ring for one fight only, fight the slow growth of an economy or high inflation. This situation is different and they need to choose wisely which fight they're fighting first.
There's going to be, when you're stuck with two trade-offs, too much inflation, or you're stuck with too much economic weakness, then you navigate through the middle, and that means something like stagflation.
The Fed actually began some quantitative easing to increase the liquidity in order to stimulate the economy. Some of that money went into the stock market, leading to an increasing demand and therefore caused in particular tech stock prices to go up. Even though we see new COVID waves, the Fed has finally started to increase the interest rate. It's actually the second round right now. We can expect another 6 interest raises within the next 2 years. Another 3 by end of this year, probably ending up with 2%. The increase in inflation rate will actually negatively impact the stock market, even higher than the devastating war we are witnessing at the moment in the Ukraine. I will now give you a few reasons which speak for stagflation and some reasons which speak against stagflation. Make sure you stick around until the end, where I'm going to show you how I invest in times like these to protect my investments from the inflation. So what speaks for stagflation? Reason number 1, Corona. The pandemic was setting the scene and was setting the foundation in demonstrating the vulnerability of supply chains in a global economy. Those shortages or bottlenecks led to price increases. Also, the Fed was printing money in an unprecedented scale to support the economy while keeping the interest rates really low. In some countries with negative interest rates. Additionally, some of the baby boomers retired during the pandemic. This meant companies had to replace them, leading to higher salaries and ultimately putting more pressure on the inflation. Reason number 2, which speaks for stagflation, is the Ukraine conflict I was just highlighting. So Russia is among the largest producers of natural gas in the world. Lots of countries are also dependent on Russia's and Ukraine's coal, wheat, gas, palladium. This demonstrates yet again how dependent we are also on oil. I'm sure you have noticed the petrol prices exploding lately. Oil is everywhere. Just look around. It's in your shirt, it's in everything you wear, your favorite sneakers, it's in your Mac, it's in your iPhone, it's in plastic bottles, it's in medicine, toothbrush, your body lotion, you name it. It's very much everywhere. So, and guess what? Those price explosions at the petrol station, we are going to see now as well with all the other products. So those explosions will actually hit our daily lives. Reason number 3, which speaks for stagflation, are the central banks. The Fed and the European Central Bank are basically screwed as they're facing an unsolvable problem. Usually they would need to increase the interest rates in order to reduce the number of loans. This would then actually ease off the pressure on inflation. However, if they would do so, they would harm the global economy as the production costs are skyrocketing due to the oil crisis and the supply chain bottleneck. Companies who would need to get new loans due to those reasons would need to pay higher interest rates in order to stay liquid, but would not be able to afford those. This would then ultimately lead to layoffs and mass unemployment. Increasing interest rates also lead to investors leaving the stock market looking for alternative investments. This could lead to a major sell-off. The pressure of the central banks is extremely high, as increasing the interest rates could be fatal for the fragile economy. At the same time, a collapse because of the oil crisis seemed to be unavoidable. And also financial experts such as Ray Dalio or Charlie Munger are expecting a recession.
I think that most likely what we're going to have is a period of stagflation. And then you have to understand how to build a portfolio that's balanced for that kind of an environment.
Guys, don't panic. Also, what specifically concerns you? Let me know and please leave some comments in the comment section below, and I'm happy to respond as soon as possible. Alright, let's have a look for reasons which do not speak for stagflation. Reason number one, which speaks against stagflation, is even though Russia is an energy superpower with all its natural resources, in particular gas, and is also the largest country in the world by area, the Russian economy, based on measured on GDP, however, plays a minor role in the global market with around 2%. Due to the sanctions, you cannot trade Russian stocks anymore, so they've also been removed from all ETFs and index funds. Don't worry though, if you have been invested into the emerging markets or global ETFs, as Russia is only representing 3% in the emerging markets, it's 0.3 or 0.4% only being represented in the MSCI world. And it's only fairly unlikely that the Ukraine conflict will negatively impact the banking sector, as the banks had to follow strict guidance after the global financial crisis in 2008 in order to prevent from another major collapse.
Not in generations has Wall Street absorbed the number of body blows it took today.
The American financial system is rocked to its foundation as top Wall Street institutions topple under a mountain of debt.
When you step back for just a moment, consider the events of the last few days. It is truly unbelievable.
Psychology. What the stock market does not like is uncertainty. The uncertain outcome of the Ukraine conflict is leading to sharply increasing prices of commodities such as oil, gas and wheat. Or same as with stocks, we are trading future predictions, and with those are wrong, those aggregations which are driven by fear will get re-evaluated and prices drop. What to do in a stagflation? I'm glad you asked. So the question is, how long will it last? Companies learn from the corona outbreak and the massive impact that has had on the supply chain. And if you read the balance sheets of the big players, you can see they're doing really well and they're actually adapted really quickly. Same thing will happen when they're learning from the Ukraine conflict and potentially even leading to more decentralized organizations. So they're not too dependent on one country or one manufacturer or one supplier anymore. This might lead to some additional volatility and uncertainty of investors. And yes, stagflation is bad for the stock market. I wouldn't try to gamble on commodities or even companies benefiting from that conflict. But again, this is only my personal opinion and ethics. If you're a long-term investor invested in solid companies or even better into global broadly diversified ETFs, as I did, you shouldn't worry too much. This is a marathon. I keep my automated ETF investments running every single month and even look for opportunities to buy some more. So far, I've not found any big opportunity, but make sure you are subscribed so you'll be one of the first ones to know. If you just started with investing, you don't know exactly how to start investing, please click here. And if you have not set up an emergency fund yet, please click here. I'm sure this will help you. And with this, I'm out. See you in the next video. I'm Björn from the Avenue to Revenue. See you in the other video, guys. Bye.